All right, so let's compare that to replacing the machine in part B. Take a look at this. So groundhog meat sausage machine in the previous problem could be replaced with a new model at a cost of $29,000. So same tax rate, 35%, required rate of return. This one's a little bit different. So they say the appropriate discount rate would be 13.5%. So 13.5%. Okay. And it would reduce operating costs up to $6,000 per year. So again, you're not given revenues, but notice you're actually given a reduction of operating costs that we see. So the new machine could be depreciated on a 5-year straight line method. That means you take 5 years, divide 100% by 5 years, and that's 20% per year. And we want to know what the NPV is. Okay, so years would be 5. We're going to go with 5 years. Cost of the new machine, $29,000. Salvage value on this one, we're going to say is $7,500. Does it tell us? Nope, it doesn't tell us that. Okay, so no salvage value on this. Not worried about it. Depreciation rates, 20% per year. Okay, so year 0, let's scroll down. Year 0, we don't have any operating cash flows. Working capital, we don't have any working capital, so that's going to be 0 all the way through. Okay, purchase of a new machine is going to be $29,000. Right, and the sale of old machine, we're going to have up top would be, this should be a negative, sorry, negative $29,000. Our new machine, the net salvage value should be that. Okay, so we ought to get that much in it, so therefore we can add those together. We have that. Notice this is the after-tax cost, so our free cash flows would equal operating cash flow plus working capital plus my CapEx would be that. So then let's look at years 1 through 5. Our operating costs are going to be reduced by $6,000. So we can highlight that and put it in there. Depreciation is going to be the same every year. So it's going to be the $29,000 times 20%. And that never changes. So we can hit that. Now there's a different way. Oops, that would be a negative. One of the things you can do is say, hey, every year it's the same thing, equals this, enter, equals this, enter, equals this. So it's the same thing every year. So our net operating income, we can add that up. Oops, it included it, did it again. So be careful of that. You'll see that. And then we can copy this cell all the way over. Taxes, so again, we have a negative operating income, so we're going to have a negative or a positive tax. We're going to have a tax credit. So my $11,800 times 35%. And we can go ahead and copy that all the way over. Oops, didn't lock in my tax rate. Didn't lock in my tax rate. Let's hit the right key, F4. There we go, F4 to lock it in. Highlight it over. There we go. That makes more sense. That looks a little bit better. Same amount all the way across. Add these up. Should be the same amount all the way across. There we go. Add back in your depreciation of $5,800, which is going to be a positive here that we would have. Drag that across. Auto sum these two. All right, so we have our operating cash flows that we have there. Now, should be able to come down here. We have no other capital expenditures we have to worry about, so we can go ahead and copy this formula, right? It's operating plus working capital plus CapEx. So we would have that. Let's go ahead and calculate our NPV. Our cost of capital is 13.5%. Future cash flows would be this. So we have 6049, and we're going to add in the 2875. So notice it would actually be better to go with the new machine. Go with new machine because the NPV is a lower negative, or the net present cost of replacing the machine is actually lower than